When it comes to your money, we know it matters, and therefore it's worth spending some time on learning how to invest your hard-earned worth. Let's use Charlotte's story as an example. Charlotte has saved up some money. To grow her savings, she is looking for an investment option. She is pretty confused with the options and the risks involved in each of them. Aren't we all to some extent? Let's take a look at some of the popular investment vehicles that can help Charlotte. In this part 1 of the video, we will talk about CDs and bonds. In our upcoming video, we will talk about other investment options including stocks, ETFs, mutual funds, REITs, and annuities. No problem if you don't know what those stand for. We'll explain the upcoming videos. To watch these upcoming videos, please subscribe to our channel and press the bell icon. Certificate of Deposits, or CDs, is an investment product offered by credit unions and banks, which offer an interest rate in exchange for the customer agreeing to leave a deposit untouched for a predetermined period of time. The duration of investment could be 3, 6, 18 months, or full year increments, and the interest rates are locked in. Once the CD matures, you get back your initial investment and additional money on interest rates that was agreed upon. There are penalties too if you withdraw sooner than expected. Interest rates do vary from bank to bank. Today's top bank might pay you slightly lower than what the online bank or local credit union might pay. But now the question is, how would Charlotte know that she is getting the best interest rates? National interest rates are determined by FOMC, Federal Open Market Committee, and the committee meets every 6 to 8 weeks to decide whether to raise, lower, or leave the interest rates at the same level. Based on this piece of information, banks decide the interest rates on mortgages, car loans, student loans, and also interest rates on CDs. Banks offer interest rates around the rate that is decided by the FOMC. So CDs are one of the safest options that are available, mainly because the rate is fixed and doesn't change even if the economy is bad. So you know what your return will be when you invest. Overall, it sounds like a great option for Charlotte, but she wants to know what happens if the bank fails or goes bankrupt. In this case, most of the banks are FDIC, or Federal Deposit Insurance Corporation insured, and they will cover your money. Just remember to check if the institution is FDIC insured and the coverage limit is more than your initial investment amount. You can contact your local bank to open a CD account. It's as easy as that. Now to bonds. Bonds are a type of fixed income investment where you get paid interest semi-annually or annually. In this case, Charlotte can lend her money to the government, municipalities, and big corporations. A bond represents a promise that the government or corporate will pay you back the principal with interest rate. Usually a bond is issued to a new project or ongoing expenses by the bond provider. For example, if the government wants to build a baseball stadium, it can raise money by floating a bond. As the individual investor like Charlotte, you can also lend your money to build the baseball stadium. Typically, bonds have a minimum investment of $1,000. The bond term includes face value, which is the amount the bond will be worth at maturity, coupon rate, the rate of interest the borrower will pay, maturity date, the date on which the bond will mature and the borrower will pay you back the principal, and issue price, it is the price at which you buy the bond. The price of the bond changes in response to the changes in interest rate decided by FOMC, and the interest rates vary from bank to bank. There are 2 main criteria to decide the rates for each specific bond. 1 is maturity date and 2 are credit ratings. Credit ratings for a bond is generated by credit rating agencies like S&P, Moody's, and Fitch. The very highest quality bonds are called investment grade and include bonds issued by the US government and stable companies which offer low interest rates. So ultimately your risk is lower. Bonds that are not considered investment grade are high-yield bonds or junk bonds which offer high interest rates to compensate the risk of investment. These bonds have a higher risk of default in the future, and the investors demand a higher coupon payment to compensate them for that risk. So let's consider a real-world example. Say that the interest rate is at 5% and then $1,000 value when Charlotte buys the bond. She would receive $50 interest income annually. A couple of years later, interest rates drop to 4%. The original bond becomes valuable because the bond was issued at a higher interest rate of 5%. So more people will try to buy the 5% bond, and the demand for that bond goes high, and the face value of the bond also goes high. The increased price will bring the bond's total value, yield, down to 4%. On the other hand, if interest rates rise, the bond's price will decrease and begin selling at a discount. Unlike CDs, Charlotte has the ability to sell bonds at any time after they have been issued. Charlotte doesn't have to hold the bond until the maturity date. The bond market tends to move inversely with interest rates because bonds will trade at a discount when interest rates are rising and at a premium when interest rates are falling. You can contact any brokerage company to purchase your favorite bonds. So there you have it. Tell us about your investment options that you are interested in the comments section, and we will cover that for you too in the next part of our video.